Felix here. This is the stuff that nightmares are made of. No, not this lovely little pussycat who's my chief financial advisor. No, it's Jay Powell. I'm worried about him. Why am I worried about him? Because his nightmare has just come true. It's a rerun of the last Fed blackout period about to hit. And this time he knows what's coming. And therefore, you and I need to really understand this because there's some serious risk here with or without cats. Before we jump into that, make sure you get your pause on the benchmark of all benchmarks, 500 stocks, felixfriends.org/SP500. Get your pause on that and you know exactly what's going on with the key stocks in the market. Of course, none of the following is financial advice. No, it's all from Tallulah. Where's Tallulah? Here is Tallulah. You know, that's who you're listening to here. Let's jump straight into it then. Here's the benchmark again, felixfriends.org/SP500. It's free, completely free. I make these for you to make you smarter investors. Before we really get started with this, let me jump straight into, I'm going to just reorganize this so that we get into the meat of this first. And that is financial conditions. The one thing the Fed wants is they want to tighten financial conditions. They want you to feel some pain, shed some blood, make some people unemployed, and that's how they be happy. And unfortunately, financial conditions have eased. So what you would expect to see on this chart is that the blue line, which is what the Fed's sort of fund rate is, the interest rate is, and you'd expect financial conditions to basically go in line with that. Now, what have they done instead? They've come down. What does that mean? It means us stock people, we have decided that the world isn't quite that bad and that, yes, we will make money and we will live happily ever after and that, you know, fluffy kittens are a nice thing to have on your shoulder. Ow. The trouble with it coming down is that they're going to do something about it. And if they're going to do something about it, it's going to hurt you or me. So what happened in the last blackout period? The last blackout period we had in the summer, the S&P was trading at 3,600 and financial conditions were a lot tighter than they are right now. And then we had this kind of thought, well, maybe the Feds have overdone it. Maybe they're going to go a little easier on us. And the market rallied and the Fed came back and they hit us very, very hard with that great big stick that they carry. So given that we are now at 4,000 or thereabouts on the S&P and financial conditions have eased, what do you think Papa Powell is going to say tomorrow? Do you think it's going to say everything will be wonderful and we should all sing Kumbaya and dance around the Christmas tree? No. He's going to do his utmost to give the toughest speech the man has ever given. He might even omit words such as lag, which is what we're all hoping for. He talks about the lagging effect and not doing too much. So how's the market taking this so far? The market is blind to it at this point. And you might therefore be thinking, well, why are you talking about it, Felix? Do you think you're smarter than everybody? No, I don't. But I want to point out a risk here. Volatility knows more or less only one direction. Well, it's come up a little bit again, but not a great deal. It's still at 22, which considering where it's been this year, it's kind of every time we hit that sort of 20 mark, we've bounced back up, and that's sort of what we seem to be doing here. So what does that mean, higher volatility? Typically, it means lower stock prices, and it means scary stuff happens. Scary stuff. Why does scary stuff happen? Because we're about to realize that the macro is about to get worse. By the macro, I mean GDP slowing down, people getting unemployed. You might be thinking, well, I rejoice because it means my tech stocks recover, but there is a slightly longer thought to this, and that is if the economy actually gets worse, which it will, in my view at least, and it means people will spend less. It means earnings will go down, and stock prices tend to move with earnings, at least in the long term, not in the sort of crazy short-term, FTX type world that we're in. So this is Morgan Stanley's leading indicator on earnings, and it's saying get a parachute. That's what it's saying. It's saying it's going to go down significantly. It's apparently going to go down to sort of like, well, it doesn't tell us exactly where it's going to turn around, but at least a sort of moderate 2015, 2016 type recession. And apologies, my lighting is a little dark. I'm a bit backlit, right? I'm taking advice from Donald Trump on The Apprentice. Remember the good old days when he was just an orange man who was entertaining? Well, he was always backlit. That was one of his pieces of advice. That was not on purpose, by the way. Non-PMI, again, an indicator is basically saying, well, we are going to go down a lot in terms of economic activity. We're going to go down to sort of 2008 global financial crisis, or as I call it, thieving, lying credit rating agencies kind of a world. So what does all that mean if you take all of that together? Well, all of that means the world isn't looking all that happy. So am I doom and gloom? No, I'm actually moderately bullish going into year end. But you got to understand how the market's positioned. You got to understand how institutions are positioned. And at least I think you do. What have we got? 4,100. You've got this great big resistance line there. Hard to break through that, even in a Christmas rally. And then you have at the bottom, 3,600. That's our support. That's where all the puts are. That's where we would see some serious buying. And then somewhere in the middle at 3,979, we're at zero gamma. We're above that level. It means the sun comes out, the sky is blue, the birds are singing. And below that, well, it's just crows, a few pigeons, and people screaming down the road. Volatility picks up below that. At the moment, we're below this level. And there is one more level, which is 3,969. This doesn't have a deeper particular meaning, but that's where the CTAs start buying. So if we end the day above 3,969, we should be getting about $9 billion worth of CTA. That's technical funds buying. Below that, well, not so much. So watch out for these levels. They're super important. And how can you make money out of these little bounces up and down? Well, we do. We are up 131% so far on the year. And that is on what? It's on capital used. So I've used on average $14,000 in this small portfolio that I run for you guys live. And we've made $19,000 profit. So we haven't done too badly, have we? We literally added $19,000 on top. You can learn exactly what that trading protocol is, how it all functions and so on. Go to felixfriends.org/coaching if you have at least a 5-figure portfolio. Why? Because if you have a smaller portfolio, coaching doesn't quite make sense yet. But if you've got 6 figures, 7 figures, and so on, it does. If you're just starting out because you're not quite at 5 figures yet, or you're just new to investing, check out felixfriends.org/options. It's a 100-lesson pre-recorded program. You get to watch me trade live every single week. Like I went live yesterday, for example. I'll probably go live again tomorrow. And you get the full shebang. You get the full strategy. You get all of it. And you get to see how I put it into place as well. And you get access to my master options portfolio. Write down this coupon code here, guarantee. That is a 41% coupon, which expires today because today is, what is it, Cyber Tuesday or something. It'll be the end of that today. So jump on that, felixfriends.org/options. I genuinely appreciate you tuning in. I apologize for being in the dark here. I'm not quite sure why we're in the dark so much. Yeah, so some stuff to think about is really like the Fed, I think, is going to try and be pretty tough tomorrow because they don't want to repeat of the blackout period that we had last time around. They don't want us rallying to 4,300 and then having to raise interest rates even more, right? They don't really want that because they're raising interest rates even more. What's going to happen? Well, what's likely to happen then is that they would break the treasury market. And if you break the US treasury market, well, that's not a good thing to break. What would happen? Well, they'd have to buy government debt again, which is basically money printing. It would undo all the good work that they have done from their point of view. And therefore, they would go into the Aspen January ski break feeling very glum. And there'd be less champagne parties and so on. So I doubt that they will want to do that. So we want them to do that 50 basis point hike in December and not more. And therefore, actually a pretty tough love chat from Jay Powell tomorrow is exactly what I'm expecting. So join me for that one, by the way. I will live stream it and I will give you commentary on what he's saying compared to what he usually says. And I appreciate you watching. I appreciate you tuning in. I hope to see you on the next one.